Let's delve into the much-anticipated Bitcoin halving event and understand why it's crucial to gear up for it sooner rather than later. Could we be on the cusp of a Bitcoin value surge, surpassing its previous peak of $67,000? To grasp this, we need to unpack three fundamental concepts related to Bitcoin and its network, ensuring a comprehensive understanding of the Bitcoin halving, its purpose, and its historical impact on Bitcoin's value. This preparation is key as we approach the next halving, slated for early 2024. Today, we'll uncover the mysteries of the Bitcoin halving, what it is, why it occurs, and its potential impact on Bitcoin's future. So fasten your seatbelt and welcome to Inside the Future. Firstly, let's talk about the Bitcoin blockchain. In its essence, the Bitcoin blockchain serves as a continuously updated ledger of all Bitcoin transactions. The easiest way to comprehend the blockchain concept is to split the term into two: blocks and chain. Picture a sequence of transaction records, like funds transferred between individuals, being compiled sequentially. Once a specific number of transactions is accumulated, a block is formed, limited by its capacity to hold a certain amount of transaction data. Roughly every 10 minutes, a new block of Bitcoin transactions comes into existence. When a block reaches its data limit, it's appended to the preceding block, forming a series. Thus, a blockchain is a series of transaction data blocks linked consecutively, akin to a chain. The backbone of the Bitcoin blockchain is a global network of computers installed with Bitcoin software. Whenever Bitcoin transactions take place, this data circulates across the network. These computers validate transactions, incorporate them into their version of the Bitcoin ledger, and disseminate the updated ledger across the network. By the way, if you want to check the best cryptocurrencies to get started, I recommend checking out our top 5 cryptocurrencies for beginners video. Just click the link above to gain a richer understanding. Now, let's explore. Let's talk about the second concept: Bitcoin mining. Bitcoin mining is the mechanism by which computers or miners on the blockchain network validate new transactions. This validation process is pivotal for ensuring the accuracy, immutability, and overall security of the network. These miners adhere to a proof-of-work consensus protocol, which involves utilizing computational power to solve and create cryptographic hashes. These hashes link transaction blocks together, with each new block having a distinct hash derived from the previous block. To get a block published on the ledger, miners must generate a new unique hash, which undergoes validation before being appended to the blockchain. To simplify, the essential aspect to grasp for understanding the Bitcoin halving is the miner's reward system. Miners receive Bitcoin rewards for every new block of transactions they verify. These rewards consist of both newly created Bitcoin, introducing fresh coins into circulation, and transaction fees from existing Bitcoin. This incentive is crucial for encouraging miners to partake in the mining process, thereby auditing and maintaining the Bitcoin network. Moving on to concept 3, the Bitcoin supply. Delving deeper into Bitcoin reveals striking parallels with gold, and that's by design. Satoshi Nakamoto, the enigmatic creator or group behind Bitcoin, intentionally infused the digital currency with gold-like attributes. The resemblance is evident in the Bitcoin mining process, akin to the arduous task of discovering and extracting gold. Just as finding new gold deposits and operating mines demands significant effort, Bitcoin mining requires substantial computational power to generate novel hashes and validate transaction blocks. Another aspect where Bitcoin mirrors gold is in its finite supply. Nakamoto set Bitcoin's cap at 21 million units, emulating gold's limited and stable inflation rate. Picture a future where gold becomes increasingly scarce, making mining prohibitively expensive. As a result, the finite stock of already mined gold would likely appreciate in value over time. as no new gold can be added. Similarly, Bitcoin, with its capped supply and consistent or rising demand, is expected to appreciate over time, defying traditional inflationary trends. Bitcoin's inflation rate is predictably gradual, as the supply of Bitcoin increases with each newly minted coin by miners validating transactions. This will continue until the maximum supply is reached, eventually reducing its inflation rate to zero. As of this video, approximately 19.3 million Bitcoins are in circulation out of the 21 million total. Predictions suggest that the last Bitcoin will be mined around the year 2140, approximately 117 years from now. Therefore, within our lifetimes, we'll witness the continued incremental increase in Bitcoin supply. Now that we have a solid grasp of the Bitcoin blockchain, Bitcoin mining, and Bitcoin supply, let's dive into the Bitcoin halving. So, what exactly is the Bitcoin halving? The Bitcoin halving is an event where the block reward for Bitcoin miners is slashed by half. At the time of this video, the block reward stands at 6. The reward for Bitcoin mining currently stands at 6.25 new Bitcoins, which were not in circulation before. With the upcoming halving event in early 2024, this reward is set to halve, dropping to 3.125 Bitcoins per validated block. Bitcoin halvings are hardwired into the network's protocol to happen every 210,000 blocks. Given that a new block is finalized approximately every 10 minutes, this translates to a halving event roughly every 4 years. The last one took place in May 2020. Back in 2009, when Bitcoin was first introduced, miners received 50 Bitcoins per block. This reward was first halved to 25 Bitcoins in 2012. Then to 12.5 in 2016, and most recently to 6.25 in 2020. So why exactly do Bitcoin halvings occur? Satoshi Nakamoto, the enigmatic creator of Bitcoin, designed the halving process to curb inflation and preserve Bitcoin's purchasing power. Nakamoto also anticipated technological advancements over time. As a result, as new blocks are verified more rapidly, the difficulty of generating unique hashes increases. By having the number of newly minted Bitcoins at regular intervals, the rate at which Bitcoin's fixed supply is released into circulation is controlled. At the current rate of 6.25 Bitcoins per block, approximately 900 new Bitcoins are created daily, resulting in an inflation rate of about 1. Annually, Bitcoin's inflation rate is approximately 1.8%, making it significantly less inflationary than fiat currencies like the US dollar. This mirrors gold's scarcity and low inflation rate, providing a predictable and steadily declining rate of inflation that, unlike gold, is set to eventually hit zero. Pretty impressive, right? Now, let's delve into the consequences of Bitcoin halving events. Gold is often lauded as a prime store of value due to its limited supply and production difficulty, which ensures its scarcity. Bitcoin, by its algorithmic design, is intended to be even more scarce than gold. Considering the ongoing macroeconomic uncertainties and the rising demand for Bitcoin's limited supply, it's likely that Bitcoin will see favorable long-term price movements. Following the 2024 halving, Bitcoin's scarcity will intensify further. Let's take a historical look at Bitcoin's price post-halving. In November 2012, during the first halving, Bitcoin was valued at approximately $11. A year later, in 2013, it surged to about $1,100, its highest value at that time, before plummeting to $220 and staying below $1,000 for several years. Then came the second halving in July 2016, with Bitcoin priced around $600. Roughly 18 months later, towards the end of 2017, it soared to a staggering $20,000, only to fall to around $8,000 and even $3,000 during 2019. The most recent Bitcoin halving occurred in May 2020, Amidst the unique circumstances of the global pandemic, Bitcoin's value was around $8,000 at the time of the halving. Fast forward to April 2021, it skyrocketed to $63,000, and later, in December 2021, it reached a peak of approximately $69,000, only to drop back to around $40,000 and subsequently below $20,000. Historically, Bitcoin's price hasn't shown significant movement immediately following a halving. It usually starts to gain momentum about 12 to 18 months later. However, it's not entirely clear if the price surges following halvings are solely due to the events themselves. For instance, the first major price jump to $1,100 occurred roughly 12 months post-halving, but coincided with the Cyprus bailout. The second spike to $20,000 18 months after the halving appeared influenced by market dynamics as cryptocurrencies gained mainstream media attention. Similarly, the third surge to its all-time high occurred within the 12 to 18-month window post-halving, but also aligned with significant fiscal measures during the pandemic, which saw a surge in investment in cryptocurrencies and other speculative assets. So, what can we infer about the upcoming 2024 halving? Bitcoin's popularity has surged since the 2020 halving, leading to increased adoption. However, it's possible the market may have already factored in the 2024 halving. With considerable anticipation building around the event, we could see various scenarios unfold. One possibility is a price spike leading up to the halving, followed by a notable decline as investors react to the immediate aftermath of the event. Alternatively, other macroeconomic factors could influence Bitcoin's value before or after the halving. The upcoming 2024 halving, along with other factors like the significant US election year, leaves room for diverse theories, opinions, and predictions about Bitcoin's future price trajectory. If you like this content, don't forget to like and share this video and subscribe to our channel for more exciting updates on the tech world. This is Inside the Future.